Welcome to Purpose Driven Passive Profits. This is the show where Steve Werner and Nate Armstrong, myself, get to take you through and show you how you can continue to be a good steward of your capital, even in a rapidly changing environment. Right now, we have a doozy of a change that's in front of us. And that's the fact that Jamie Dimon right now, president, CEO of the world's largest bank, publicly traded bank anyways, says right now that JP Morgan says that he's preparing for stagflation. Now, what the heck is stagflation? Why is that a scary word? Why do some people cringe and some people have no idea what that even means? Well, first and foremost, stagflation happened in this country back in the 1970s. We went through something called the savings and loan crisis. And all of a sudden, this country was in shambles to some degree economically. The reason is because interest rates kept going up to try to kill this legendary thing that you know the name that I'm talking about called inflation. Inflation. You know a thing or two about that because you've seen your gas prices go up. You've seen your milk prices go up. You've seen everything go up. You've seen some real estate prices more than double in a short period of time. And that's because there was a lot of printing of money and a lot of government spending that's not normal for an economy that's happened in the last handful of years. And consequently, it's just that money had to find a home, and it's caused prices to go up everywhere. And the only measurable, I shouldn't say the only, but the most measurable tool that the Federal Reserve has to lower prices is to increase interest rates. And so what happened during the 70s is that Paul Volcker, the Fed chairman at the time, he came in and said, you know what, we got to get this under control. We are going to raise interest rates. And so he pulled the lever hard. He grabbed that lever and he pulled interest rates up. Now, fast forward to today, you have a new animal, different problem, same problem, but different circumstances. And we have a different Fed chair. His name is Jerome Powell. Jerome Powell has come in, and this is the important part. Jerome Powell has come in and said, I admire Paul Volcker. If we need to increase interest rates as fast and as hard as Paul did, we will do that. He's publicly said that. His objective number one is to kill inflation and to get it down under 2%. And he's not there yet. He thought it would have been by now, but he's not there yet. So all these pundits out there in the news and media that keep saying, oh, they're going to cut rates. I'm sorry, but just prepare to be where we're at, higher for longer. Like mentally prepare for that, because that's probably the reality. If they do happen to cut rates a little bit right before the election to kind of appease the politicians, I wouldn't be surprised if rates start going back up again. And I'm not the only one that thinks that. In fact, Mr. Dimon himself believes that. In quote after quote, article after article, you can find this, but he believes and wouldn't be surprised, and he is preparing for rates to go up again and this thing called stagflation to happen. So what the heck is this thing? What is stagflation? Well, when interest rates won't go down and you have this like coming, I'm going to walk you through this. If we go into like today's basic AI tools and look up stagflation, it's going to tell you this. You're going to get basically three big bullet points. You're going to get slow economic growth. You're going to get high inflation and high unemployment. Right now, we have slow economic growth. It's terribly slow, way below where people thought it would be. I know some people are surprised that the economy's even still got life in it right now. We've been talking about recession for a couple of years and it hasn't really hit yet, but slow economic growth. High inflation, we're definitely living that right now. It's still high, way higher than the targeted rate that Jerome Powell is going after. And then the third thing is high unemployment. That's the one of three things that we have not seen yet. We have not seen the unemployment rate jet up. I want to caution you on something. And this part is, if you only pay attention to this one part during this entire episode, this is the part that I want you to know. Unemployment rates can jump really fast. And I'm talking like almost overnight, at least that's what it would feel like when you look back in history. I'm going to actually cite some data from the Federal Reserve. Every single time, if you go into like Fred St. Louis, fred.stlouisfed.org, you can see all their charts and graphs. They have all of this stuff available. It's all public record for everyone. But every single time that there is a recession, that's deep enough, what happens typically is the unemployment rate gets pretty darn high. And I want to point out something. The last time that we had a recession, 2008 to 2012, depending on like what state, what city, what zip code we're talking about. Some people may even just call it through 2010. But the last time that we had that, basically unemployment leading up to it was in the fours. Where are we today? Think about that. Answer that question for yourself. Where are we today with our unemployment rate? We're in the fours. Okay. And then what happened over an 18-month window is it got up to 9.9%. By October 2009, it was actually at 10% as a country. Some states were much worse than that. Some states had 12 or 14% unemployment rate. But as a country, we hit 10%. That was over an 18-month window, year and a half. It doesn't take that long for unemployment to get out of control. So if we go back to the three factors of what stagflation is, slow economic growth, high unemployment, okay, and then high inflation, we would have all three. If the unemployment rate starts going up, we will have all three. And this is what Jamie Dimon is saying is his worry right now. They're preparing for us. We've had so much government spending. This inflation's probably going to keep running for a bit. And so we've just got to buckle down and prepare for it. Now, let's go to the most important question. What can you do with your investments to be a good steward during a time like this? What can you do to protect your wealth, your money? Because we all know if you leave your cash sitting in a bank account, it's not a savings, a high interest paying savings, especially if it's just a checking account, your money's being eaten alive by inflation. The cost of goods, the cost of gas, the cost of milk, it's going up faster than the value of the cash that's sitting in the bank account. Now, I went and parked some of my cash in a high interest paying account. I recommend everybody do that right away. Like, not risky, but there's savings accounts now that are literally paying 5% interest, depending on when you catch this episode. So I'd recommend at least making that move. I'm not your financial planner by any means, so don't take my advice on savings accounts, but that's what I did for my family. I'm not just going to let my cash get eaten away by inflation. I do want to have some cash in hand too. And then the next thing is this. I went back in time and I looked at what were the smart assets, what were good places to park cash. And one that I'm going to point out, partially because I am a real estate investor, partially because this is just the reality, is real estate did pretty well. And I'm displaying, for anyone that can see a video version of this, I'm displaying on the screen right now the median sales price for houses in the United States, according to the Federal Reserve website. And they went up the whole time. They didn't have a big crash. People were kind of anticipating it because, we talked about it or they talked about it during that era. I wasn't even alive during this era. I was born right at the end of the era. But consequently, like, there was no big crash. It just was a slow, steady growth in prices going up. So a hard asset like that was good. The other thing that I do want to point out that was really good to people is specifically gold and silver. Gold was the winner. It rings the bell in almost every single category. And then one specific, I had to go back and dig for this using a little bit of AI tool, but the other one that was very specific is certain commodities. The S&P 500, specifically the GSCI, it went up a lot during that period of time. Now, you can't say that exact GSCI S&P 500 is going to be the thing that does it this time. Nobody can say that. Nobody knows. For all we know, it could be some tech sector. It could be something to do with blockchain. It could be something to do with AI. We don't know. None of us know. But I do know that hard assets typically do well in an inflationary environment. So look at gold, look at silver, look at other things that you can physically touch that they can't print. If the government can't print it, then there's a good chance that it could hold its value and increase in value. And they're not making more land, and buildings that pay dividends, I'm talking about rent every single month, every single quarter, tend to do really well. The other sector that I'm personally investing in, my family, and we've got some investors that we've invited for the journey with us, is into manufacturing. Right now, jobs are coming back to the United States, manufacturing jobs. We've seen the biggest decline in imports, manufacturing imports from China. From last year to this year, they're down by, it's the biggest drop in 30 years. They're down by 13%. That's staggering. So manufacturing back here in the United States of America is looking very, very rosy as well. But anyways, you know how to be a good steward. of your money. If we enter this stagflation environment, which Mr. Dimon thinks we're going to, and I, for one, do believe the same thing. If we do enter that environment, you have to be an excellent steward of your money, because just parking your money in a savings account isn't going to do much good if inflation just keeps going and going and going and eating it away. That's all for this week. Next week, I hope to be back and rejoined again by my co-host and partner, Steve Warner. This week, I hope you got a couple of good nuggets. If you got one piece of value from this, I'd love if you could add one piece of value back to our world, and that's to rate us and review us. These podcast platforms and other people out there in the world, they do listen. They read. Your ratings and reviews make a huge difference. If you could take a second to rate us and review us, we really appreciate it. I read those. I appreciate those. And the second thing is that if you know there's somebody else out there that could use nuggets from this show, then please share this with them. It doesn't cost anything for you. It's totally free. It'll only take a minute to press the share button and send it to them. I'd appreciate that. Okay, thank you. God bless. We'll see you on the next one. Hey, accredited investor, Nate Armstrong here. I'm very excited to talk about our new deal right now. It's our cash flow fund number 7. We're buying beautiful real estate with machine shops operating on top of them. Why, you might ask? Well, supply chains got broken. Think about this. What happened during COVID? What happened to the supply chain? They got smashed, destroyed. And so a lot of companies right now are bringing their manufacturing, their machining back home to United States soil. And so it's an incredible opportunity for us to buy these properties that are cash flowing like no other, with huge demand into the near future. To learn more, all you have to do is go to homeinvest.com or click in the description down below. Always consult with a tax advisor, financial planner, or an attorney before making an investment decision. Having said all that, all you have to do is go to homeinvest.com or click down in the description below. Thanks. God bless.